All right. Good morning, everybody. We made it. CPI day. We're done with POW, focused on options expiration, which is going to be next week, and getting through CPI. It's also the start of earnings season this week with the banks. One of the things about CPI day is the setup that we have to play and the lack of opportunity everywhere else until the market settles down. So we'll take a look at what's going on out there, but we'll also focus on this setup because things that are up or things that are down very likely will change once we get CPI. So US Dow is down not quite 0.25%. S&P, NASDAQ, and the Russell flat. Japan flat. UK up about 0.25%. Everything's just in this hurry up and wait mode, looking for this data to come in. In the later part of the day, we're going to get the monthly US federal budget at 2 o'clock. For some reason, I kept looking for that yesterday until about 10 when I came back in and looked around and realized, oh, that's tomorrow. So it's today. I mentioned it yesterday, pointed out how this is one of those subtle ones that don't really get a lot of attention. But when it hits at 2 o'clock, you can feel it. When we take that and add it to all the speakers that we're going to get, CPI and everything else, it's going to be a pretty eventful day. We have the 30-year bond auction today. It's not the sweetheart, but it's still a good one. Certainly want to pay attention to that. I can't tell you how many times I've seen the market move on the 30-year bond auction. And that's at 1 o'clock. So we're going to have a Fed speaker at 1. And we're going to have that bond auction at 1. And then we're going to get the federal budget deficit at 2. So it'll be a busy day even in the afternoon. This was the afternoon that I was looking for yesterday. That's a nice little cheat sheet. I'll take that. So let's talk about the setup. Some of these examples are from a CPI morning. Others are from non-farm payrolls, PPI. There's always an 8:30 opportunity. We get at least 3 chances every month for this play. And at the very least, even if you're not interested in trading a gap close, at the very least, what I'll hope you get out of this is, say we get a big move down on CPI at 8:30. Hopefully what you get out of this is that you don't wait until 9:30 at the open and buy a bunch of puts thinking the S&P or the Qs or whatever is headed to the downside just because we got the big print to the downside, right? If I can save you from doing that, at least, then we're ahead of the boat. On the other side of it, if you trade futures or, even just trade as a day trader, playing this gap close play, not a bad way to go. There's a couple of conditions for this setup. And if we don't get the setup, it's not a big deal. It's not that we wouldn't trade at all if there is no setup. We would just look for a different setup, right? We find something else to trade. There's almost no wick across the top of this. So when the data came out, price immediately moved in one single direction. It didn't wick up first and then fall. It just fell. It also closed near the low of this candle. It didn't set that low and bounce up and close somewhere near the middle. We don't want that. I like to break a candle down into at least two pieces, the 50% mark with the above and the below. But even breaking it into four pieces isn't a bad way to go. And if we did that, just 4 quarters, right, like a dollar, then we want to see the move hold better than 75%. So if it set this low, we wouldn't want it to bounce back up more than 25% of that. We're looking for it to make a move, build a base, and then work to get the gap closed. The gap would get closed when we get back to where we started, generally around 10:30 or 11 o'clock. It's no kidding. That's why I always say watch the clock. Watch the clock. It's one of the best indicators you can put on your chart is just look at what time it is. This is a downward move, but it doesn't have to be a downward move. We'll take an up move or a down move. Here's another example. 8:30 print. We got news. Price went in one single direction. It didn't go down first. It just went straight up. And it closed near the high of that candle. Price worked its way back, got there around 10:30. And I know, I get it. You don't see a gap. You see a candle. What gap? This isn't a gap close strategy. There is no gap. I get it. The thing is, there's a liquidity gap, right? And that is the gap we're closing. And it's more of a turn of phrase than anything else, because there honestly is no gap. Even as price runs really fast, there are orders filling behind it as it goes up or down in the other picture. So there really is no gap, but that's what this is called, as a gap close play, a liquidity gap play. This one really didn't base. Once it set that high, we had the last hurrah and it started to go back in the other direction. It really didn't build a pattern up there at all. Another example, this one had multiple candles all moving in the same direction, but the start was exactly the way we wanted. And if we were to break this candle into 4 quarters, it did close in the upper 75%, right? This last little 25% here. Now, when the new candle opened after the first candle closed, we would also want to see that one maintain these highs. We wouldn't want to see it fade back even to the 50% mark. We wouldn't want that kind of fade at all. It needs to maintain this pressure and continue to rise, or if it was a down move, to continue to fall. Yeah, it's a good question. I never actually say it most of the time. These are 5-minute charts, right? So does that matter? I mean, if you're looking for a replica of what you're seeing on my screen here, trying to see if the candle closed or the candle opened with no move to the downside and went in a single direction, yeah, you're probably going to want to look at it on the same time frame, right? The 5-minute time frame. Because this setup visually is on the 5-minute. Now, I'm going to show you examples later where we have some intraday setups. And once you understand what the setup looks like, you could do it on any time frame. It's not stuck on a 5-minute. But if you're trying to mimic these examples to trade something that looks exactly like these gap closes, you're going to want to start with a 5, right? We did get back down 10:45 or 11 o'clock, pretty close, within that 30-minute window from 10:30 to 11. This is what we don't want to see, right? It's a really good example of trash and what we want to avoid. One, it went down a little bit before it went up. It wasn't a lot, but it was enough. We don't want this. Don't want anything like that. Then it set a really big high and it pulled back more than 75 or below the 75% mark. So it didn't close in that upper area. In fact, it closed a lot closer to the middle, and we don't want that either. The next candle after the first candle tried again and set a lower high, and then everything just unwound, and we went back and got the gap closed within about 30 minutes. This isn't the setup that we're looking for. We don't want anything that looks like this. This was non-farm payrolls from February 9th. Here's another example of what we do not want. Big wicks on each side, price closing near the middle. This is not the setup. Another example, it's not what we want. And another example, this is not what we want. Now, this is the examples of the intraday setups. And, depending on the chart time frame that you're using, you could see these setups all over the place. They don't fill immediately. So when you get that first initial big move, we're not looking for price to just immediately run right back down and get that closed. In fact, the move started at 10 a.m. and it didn't get closed until 3 o'clock. But even after we got that really big move, this is the gap that needs to be closed. We ended up getting another gap here. That one was closed in less than 20 minutes. Price went right back up, right to the penny. It went right back up to that gap close. Maybe it's a coincidence, right? To the tick, it went back up and closed that gap. Then we got another one here. So in the move down, it closed that gap, and then price turned right around and ran right back up and closed the gap. So we do get them all over the place. It's always worth considering. And I've shared this multiple times, right? Just about every time we get a CPI or a PPI, I bring this up and show it for a number of reasons. One, I'm just trying to, say it often enough that it starts to stick. There's one side of that coin. The other side, though, is when we get done looking at the ES and the futures and kind of evaluate things, there's not a lot left for us to look at. We don't really want to go look at a bunch of stocks and see what they're doing this morning, because they're not going to stick, right? Usually CPI is going to rock the boat, and anything that is up may turn down and vice versa. And so there's really just not a lot of reasons to go looking around like that. It is worth noting that today's channel is outside of yesterday's channel. They're not overlapping in any way. What I mean by that, this is where two channels are overlapping. The new day's channel is inside the previous day's channel. That's an overlap. We don't have that today. It's higher than the previous channel, which is mildly bullish in context. It's a really wide channel, which implies if we attempt a breakout, that the breakout will fail. Just keep in mind that this channel doesn't make price do anything. So if it's wide or narrow or whatever, it's not making price breakout. It's not going to make it a trend day if it's a very narrow channel, and it won't make it a range day if it's a really wide channel. What it is giving us is some context what price should do if it attempts to break out on a really wide channel day is fail, that the breakout won't stick. That's generally what we would be expecting on a wide channel day. It is worth noting how far away we are from the weekly pivot. And I mention this quite often because I just still don't have a quantifiable measure that says how far from the weekly pivot can we get before it's too far. We could use language like overbought, oversold. I don't really like that phrase, but it would fit. How far is too far? I'm gonna say we're there. I don't have a better metric. Those that know me, I'm missing my pinky and I got a little nubby, and I usually just wiggle at people and say about that much. It's about that much. We're there. Yeah, I know. A poor joke. It's true. We are above the pivot point this morning. We haven't hit it. That gives us an MDP, a missed daily pivot, but it doesn't count today. It counts tomorrow. So on all these days where we didn't hit the pivot, the next day, that would be a missed daily pivot follow through. And then, of course, we had multiples, right? 3 in a row. 4, actually, if we go back just a little farther here. Wednesday, Friday, Monday, Tuesday. 4 days in a row of missed daily pivots. We tangled up in one yesterday, got a nice little reset, and then an expansion. Spot Gamma's founder's note from last night was talking about how around noon, all the options flow was just really bullish and it never turned back. The put flow was basically flat and the call flows just really accelerated into the afternoon. And it was just a really nice confirmation of that continuation higher and higher. And you can see the lines that we have here, R1, R2, R3, and we really expanded beyond those. But in context, look how narrow that range was as opposed to, say, Monday's range. Sure, even if we took Monday's range and brought it over to yesterday, we broke even that range, but not as much, right? So these ranges can be misleading if we're only looking at the R levels and the S levels without backing up and looking at it in context, like this zoomed out chart, where we can see that yesterday's S and R levels were really narrow compared to the previous days. And that's because they're derived from the previous day's price action. The more sideways price is, the more constricted the next day's lines are. All right, we had a big move Friday, so Monday had a really wide central pivot range. Monday moved less, so Tuesday had a smaller range. Tuesday moved even less than Monday did, and so Wednesday had an even smaller range. Now look at today's. It's huge, right? We made really big moves yesterday, and now we have this massive central pivot range today. That's the way it works. So getting to an R2 today, as opposed to getting to an R2 yesterday, is two completely different things. I mentioned this just to point out we can't have just, like little robots trying to trade mechanically without context, getting to S&R values without really considering where those S&R levels are in relation to the rest of the market. On the week, the dollar is basically where we were Monday. So like a hamster on the wheel, a whole lot of work for nothing. I think it would be interesting if it fails support here and continues to the downside. Same with the 10-year. We've been kind of bumping along these lows since Friday. We're right back where we started. All that work for nothing. The 10 keeps pressing down lower and lower. If this support gives out on the 10-year and the dollar, and we see both of those move to the downside, we could see another leg up in the NASDAQ and the S&P. So this idea of, oh, we already made a big move, maybe we're going to go sideways or down. Yeah, maybe. But don't get caught in that idea that it owes us some move to the downside, because it does not. One of the things that Spot Gamma mentioned last night was that some of that move yesterday was from defense, right? A lot of institutions and just retail traders are short calls, and those calls are getting challenged. Well, you don't close the trade when you're that big. You just hedge against it, right? So if you've got short calls and you need to hedge, you need some serious deltas, and you just buy futures. Right? That's how it works, right? Futures have a hard delta. You can balance your portfolio a little bit when you're beta weighted by just buying some futures. And the futures were moving more than the SPX was, the ADR levels and that sort of thing. So what was going on? You don't want to stand in front of that. Even the ones that were trying to close, well, how do you close a short trade? Yeah, you buy, and that just adds to the buying, which adds to the buying and adds to the buying. So the more people try to short this and get run over, the more they're just going to buy and add to the buying. Wait for the turn. And if the dollar falls out and the 10-year falls out, we're not going to get that turn yet. I find it very hard to believe that if the dollar and the 10-year fall, that the ES and the NASDAQ are also going to fall. They may not rise, right? The 10-year and the dollar won't act like gasoline on fire and propel those things higher. So they may not rise, but I can't see them falling when those two are also falling. If the dollar does fall, gold should be a good play today. So say we do go sideways in the ES and the NASDAQ after that big move we had yesterday. A sideways day, maybe sort of choppy, might want to play something else like gold or maybe oil, something like that. If the dollar does break this low and start expanding below and gets towards that 104.5 area, we could see a really good move in gold. Get back up above 2,400 and really start to expand into that 2425 area. 2425. I like it. Looking at the Mag 7, 8. NVIDIA is coming right back up into this resistance area around that 140. So it's still under the weather. It's got to get above this, right? But look at Tesla. It took a little bit of a break, a breather around that 262. Google took a pause. Amazon took a pause. Those things are primed and ready to go. They've rested. They've consolidated. Google's got this really tight wedge pattern. It's just winding up more and more and more energy. It's ready to go. So I'm not saying that's bullish or bearish, just pointing out they are primed and ready. You take something like Microsoft, it's pulled back. It's still underneath this pivot. Netflix, it's under some pivots. NVIDIA, under some pivots. Facebook, also building a wedge under some pivots. So half of these have some resistance it needs to get through. The other half are primed and ready to run. And we've been seeing that bit of a rotation cycle, right? Where 2 or 3 of the Mag 7 names are making a run. The other 2 or 3 are just kind of hanging back, resting, consolidating. And then the money flips to those that were resting, and the ones that were running start to rest. That's what we've been seeing. So, it's worth keeping an eye on these, see if we do get that rotation. That would be rotation back into Amazon and Google and Tesla, and a rotation back out of Apple, Microsoft, Meta. And Netflix is always like that one dog that just wants to go sniffing bushes and not do what it's told, not pay attention to anything, and then run like a mad demon. So it's kind of the dummy in the lot. And then NVIDIA, it just moves so much in the last year that it's got a lot of digesting to do anyways. The volumes are light today, which makes perfect sense because the market's waiting on data. And it's lined up with a market maker move. They are hedging because they're worried. Retail can put on some hedges that will act like a regular trade, but a position that you put on that you're interested in making money from if the market moves. Generally, however, a hedge is just money spent, like house insurance against a fire. It's the perfect analogy, and I know I say it often, but really think it through. It's not a way to profit, right? Your home insurance may be $1 million, $1.5 million, but you don't want to burn your house down just to get your homeowner's insurance, right? It's just not worth it. You're not going to come out ahead of the game. They're buying this insurance, putting on those hedges, not because they're looking for a profitable trade, but because they're worried and they're willing to spend the money to protect their position. And it won't make them whole, this hedge. It will just take away some of the pain. We want to watch this market maker move signal and see what happens after 8:30. Does it continue to grow? We were seeing it yesterday on the SPY, and through the day yesterday in the SPY, it just continued to grow. It didn't go down. This is a time-based metric, and it's only for today. If there's another one tomorrow, then it would use tomorrow's data. So it's an expiring signal. Throughout the day, it should go down because time just keeps marching forward, right? There's no calling time out or rewinding it. So if the time is passing and yet the market maker move continues to grow, that shows that they're continuing to hedge through the day. So when we get past CPI this morning and we get into the 9:30 open, see if that market maker move is still there and or if it's still growing. Because if it is, that says they're worried about this afternoon. Remember, we got the 30-year at 1 o'clock. And we have that budget at 2 o'clock. So there's reasons to believe the hedge might last longer than just CPI. That would give you a heads up on how impactful the afternoon might be. $10-day, 30-minute volume profile. We left that range that we were in. And that was our one hope to move this point of control up anytime soon. However, over the next few days, we're going to lose all of these candles down here. And by default, this point of control will now move to this location. It's a done deal. The only thing that could upset that apple cart at this point is if we start getting a lot of volume right up against the top here. And it would have to happen really fast. And we would need to stay right here in this very small zone for a week. You see how unlikely that is? So the new point of control is very likely 56.12. It just doesn't know it yet. We have a new VPOC from yesterday. So if we do make moves to the downside, we have this in our way, 44.50. Yep. And you can see the amount of volume that we got up at these highs yesterday going into the close. This is called a ceiling. If it happened on the downside, we'd have called it an iceberg. You can see how price ran up into this. And if you were using a TPO chart, you could see exactly where that volume was, right? But we hit a lot of volume there. We can see it. And that's what shut down the move finally. Now we've got a very narrow IB or initial balance. We're just holding tight in this constricted range. With this range, you can, of course, give your plus and minus. just draw it from two different directions. Just like that. That gives you levels between where we're at and where the ADR lines are. These ADR lines, much like the pivot points that we were talking about earlier, they expand based on what price does on the previous day. So yesterday was a really big day. Today's ADR lines are very likely bigger by far than yesterday's lines were. It's the way it works. We are 1.7% above the 10-day. We're not quite at that level of risk. 1.5 is about the level of risk, but we're close. And you can see how often we got near that level and then we sold off away from it. So we don't have to get to 1.5. That's just a really simple metric to look at. We're pretty close to that level where we should be concerned about how far from the 10-day moving average we are. To be fair, when we get this far from the 10, I'm not saying that we're going to turn around and go back to the 10. That's not exactly how it goes. We could get this far from the 10 and just pause here and give the 10 time to catch up. We call that correction in time rather than correcting in price. A correction in price would be if price did turn around and start moving back to the 10. So a correction either way, whether it's a correction in time or price, we're just about in correction territory. Now, I'm not talking big stuff, right? It's not like I'm saying we're going to 5,400. I'm talking about a 1% move down. That's not very much. You know what I mean? It's just a minor pullback, nothing. Not even to 5,600, really. And for the distance from the 10-week rather than the 10-day, we're at 4%. This is just about where we want to be. We've been higher than that, but 4% is about the sweet spot. So we want to see things calm down here a little bit. We could go a little farther. We've seen examples of that last year in July. And well, that was 2 years ago in July, last year in May, and in December. So there's been a few times where we've gotten above that for sure. But as you notice, most of the time we don't stay above it. We get up there and come right back down again. And all the other times we just got near that line and then we started to correct. So we're there. You know, I use the phrase, have we moved too far, too fast? And does it owe us a pullback? And 9 out of 10 times, I say no. This is the 10th one. We're there. As for owing us a pullback, I'd say if we get above 5, I would look for a serious mean reversion play. But at this point, I would just look for a pause and a correction either through time or price. It is worth asking the question, where are the weekly expected move lines? Remember, these aren't accurate this week. So there's the close, 56.15. That's Friday's close. add 70 points to it and subtract 70 points from it. And that'll give us the high and low. We're there. That's what the expected range was, is 70 points higher and lower at the close Friday. So we've made our weekly expected move. I rounded a little bit, but you can always check, right? If you wanted to, go to the Analyze tab and go to the Think Back. Now, if you do this in the futures, you're going to need to choose the contract. Then set your date. So we were looking at Friday. And then look at the next week out. Friday at the close, it was 77, not 70. So I rounded it a little bit. You could use 75. We're still there. All right, you got about 22 minutes before the first data print comes out, and we're going to get data all day today. So just proceed with caution, and keep in mind, I talked about, we're overbought, we're overextended, we've moved far and fast, but corrections doesn't mean that it's got to go down to fix it. It can just go sideways and it'll fix itself. So don't get all bared up and try to short this thing just because, right? Actually get some bearish signals if you're going to want to short this thing. We'll take a look, because it doesn't hurt, but I wouldn't lean on any of these. With penny stocks, penny stocks doesn't care if it's CPI. It doesn't care about the 30-year bonds. It doesn't care about any of that stuff. Penny stocks are what we call event driven. They're going to move because of whatever, right? A drug trial, news. That's what penny stocks do. They're event driven stocks. So they don't care about the econ and all of that. If any of these were looking at penny stocks, that would be great. But we're looking at sectors, and these are going to move based on the heaviest weighted thing in there that's moving it, right? Like XLY is moving because of Tesla. So when we look at what's up and what's down, just keep that in mind. Jets are down 3%. Over the last 5 days, they're down more than 1.5. So they were up 1.5. They're now down 3. So they're down 1.5 over a 5-day period. Nat gas is down. And that's it for our benchmark of 0.5%. Looking at what's up. What's up? Bitcoin, more Bitcoin, China ADRs, China itself without the ADR list. So you got your internet ETF from China, that's your KWEBs, and then your more broader market China ETF, MCHI. VIX is up 4% in the last 5 days, but 1% this morning. Gold, emerging markets, which is just China again. Yeah, still don't understand how China has emerging market classification at this point, but they do. And then gold again. Not really what we want to see, right? We want the Mag 7 in there. We want to see those financials, um, consumer discretionaries, and we just don't got it. Cloud computing also on that list. Big drop, still inside of yesterday's range, but it's in it. It's been a consistent, persistent move to the downside. Look at that rally up yesterday. It ran right into the anchored VWAP. It's the week to date anchored VWAP, right? Starts on Monday, just week to date VWAP. That shut the move down. I love those anchored VWAPs. Still getting that rollover, but we're still inside yesterday's range, right? So even if we do get the breakdown, we're looking at $19 as the midpoint on this move. We want to see if it can find some balance there and see if it sticks and holds or if it breaks 19. If it breaks 19, we'll look to re-challenge this low below 18.5. Bitcoin proxies moving around. This has been a beatdown, and we're close to reciprocation. Whatever we got on the top of VWAP, we get to the bottom of VWAP. We pretty much got that at this point. Could look at it as a bit of a reset. We're also back down to this previous level. It's almost a perfect touch of the previous level, and that's not what you want. Say we're looking at this as a really big double bottom. You don't want it to touch the previous level and stop, because a double bottom is supposed to be a bear trap. And what bear would look at this and think, I'm going to short that sucker before it even broke through the previous pivot? They're going to wait until it breaks that previous pivot, and then they're going to try to short it. Even from the hole, they'll try to short it there. And that is what makes a double bottom so good, because then we've got people to squeeze those shorts. They buy, which adds to the buying, which is more of buying, and it spikes hard back up the other direction. Kind of like here, when we had a potential bottom here and price was coming down into it, and we got there and we overshot it because the bears really looked like they were going to pile in. That was the bear trap. And we had those 2 days of really big explosive moves back up. That was the bears unwinding their shorts. That's the squeeze that makes the double bottom so good. So now in this situation, if we didn't even break that low and get new lows, there's no reason for bears to be in there. And all we're seeing here is just profit taking from this move down. Not good enough. China's up. We already mentioned that, but it's been a beat down. So, it's not really exciting at this point. And Baidu had some news the other day, which moved KWeb anyways. Some news on their autonomous taxis. And that gave it a nice pop. But we do have the failed flag play that I had mentioned the other day. All we need is the start of this move back up, right? And we will reciprocate. The halfback is still the level of concern, though. Got to get beyond that. Gold miners, that breakover, it had a little bit of a stall here in the middle, but we're past it and we're getting right up into the area of concern. That's what a TRB owes us, right? Is back to the top. Well, we're there. This is the sell zone, and it's a big area of risk. We need to be concerned about this entire zone. The gap is closed, though, so there is that at least. I say it's closed, but that was me eyeballing it. Yep, it's closed. We hit it this morning. Now, some analysts won't call a gap close if it happened in the pre-market. They'll say, no, that's got to happen in the regular trading hours. I'm not against that argument, really. I'm not really for it. I'm just not against it. So for me, it hit it, it's closed, but I'm willing to stay open-minded about the fact that there could still be trades here or liquidity here that, you know, hasn't been dealt with yet because it didn't happen in the regular trading hours. But the TRB is done. If we can get a breakout above this box that I drew, then we've got the potential to expand 100% beyond this entire measured move. So you just use something like your quadrant lines on Thinkorswim, or take a fib and just add 1.5. There's 50% of what I just measured. This is what I measured. Make it easy to see. Measure all of this and plot that higher. Here's 50% of it, and there's 100% of it. If we break out above this previous high, then 1.5 is the first measured move, and then 2 is the entire measured move higher. We got pot stocks making some moves, but is beat down trash as well, right? And reciprocation, what we got on top of VWAP, we've already got on bottom of VWAP. It's given what it owes. As for the double bottom, it didn't really trigger all that good, right? We had this meandering sideways slop, and then it tried to push up a little bit, which failed miserably, and now we're back down again. So that double bottom wasn't a good bear trap. It just fizzled. It's like getting a bad soda, right? You go to open the can, it's supposed to pop, and instead you just get nothing. That's what this was. You got about 12 minutes. Everybody be careful, be safe, watch the clock. Can't stress that enough today. 1 o'clock and 2 o'clock, even the afternoon, you're going to see some shenanigans. And I will see you all tomorrow.